Hello everyone, John AG here, and I need you to lock in for a minute, because the metals world is doing that thing it always does, right before the crowd realizes what's happening. On the surface, it looks like just another conference, just another interview, just another mining story. But underneath, there are signals stacking up. Unusual demand, quiet contracts, ore moving, and a shift in language from exploration dreams to development deadlines. And here's the uncomfortable part. Once everyone agrees the story is real, the easy upside is gone. So today, I'm going to unpack a case study that shows you how this cycle is evolving, why certain projects start getting taken seriously, and why one specific demand angle, coming from a place most people aren't watching, could matter more than the loudest headlines. Quick note, my analytics show most viewers aren't subscribed. If you value original work and want me to keep calling out copycats, hit subscribe and comment "Our John AG" so the algorithm knows you're here. It takes 5 seconds, and it keeps this channel moving. All right, let's set the scene. Quick note, my analytics show most viewers aren't subscribed. If you value original work and want me to keep calling out copycats, hit subscribe and comment "Our John AG" so the algorithm knows you're here. It takes 5 seconds, and it keeps this channel moving. All right, let's set the scene. Stay with me because later I'll explain the one detail that made seasoned investors stop mid-conversation and pull out calculators. Not a headline, not a rumor, but a practical advantage that changes negotiating power. If you catch that detail, you'll understand why some projects explode while others stay invisible, even in the same district. That's the difference between a story and a modelable plan. Stay with me, because later I'll explain the one detail that made seasoned investors stop mid-conversation and pull out calculators. Not a headline, not a rumor, but a practical advantage that changes negotiating power. If you catch that detail, you'll understand why some projects explode while others stay invisible, even in the same district. That's the difference between a story and a modelable plan. If you've never been around the resource conference ecosystem, it's a weird mix of optimism, desperation, and opportunity. The hallways are packed, the booths are bright, everyone is telling you their story is the best story. People are trading business cards like poker chips, and you can literally feel when a sector wakes up, because suddenly the same investors who ignored emails for 2 years start showing up asking, "What do you have?" But that's also the problem. When everyone is excited, people stop thinking. They chase movement. They confuse noise with truth. They buy the loudest pitch and then wonder why they got dumped on. So my goal is different. My goal is to spot the stories where the tone changes, where the conversation isn't about maybe someday, but about here's what we're building and here's the proof we're not guessing. And that brings us to a company working in Northwest British Columbia in the Golden Triangle. Now, the Golden Triangle has a reputation for a reason. It can host exceptional mineral systems, and it can crush teams that underestimate the realities: terrain, weather, access, logistics, costs, permitting, timelines. You don't get to fake competence there for very long. The land will expose you. So when a leadership team says, "We're transitioning from exploration into development," I don't clap. I don't nod. I ask one question. What changed? Because transition can be a buzzword, or it can be a turning point. And in this story, the turning point is simple. They started acting like the next phase is real. That means they've been drilling for years, building understanding, chipping away at the system. 10 years of work, give or take. The kind of work that looks boring to a casual viewer, but becomes priceless when the market finally cares. Then they put out a resource estimate that isn't designed to look pretty on a slide. It's designed around a specific plan: direct shipping ore. And if you're new, direct shipping ore is not a magic trick. It's a strategy. Instead of building a massive plant before you ever see revenue, you prepare ore to a shippable specification and send it to a buyer who can process it elsewhere. If it works, it can reduce capital intensity, accelerate timelines, and create earlier cash flow. But, and this is where most people mess up, it only works if the ore quality and the buyer relationship are strong. So why would a company choose this approach? Because the easiest way to get destroyed in mining is to overbuild too early. Big plants, big capital, big delays, and suddenly you're fundraising from weakness. A shipping strategy can be a bridge. De-risk, generate cash, prove consistency, and then expand from a position of strength. Now, here's the part where many investors get tricked by numbers. The formal resource number that was discussed in this high-grade direct shipping framework is around 700,000 ounces. But it's important to understand what that means. It's a number shaped by a strategy. They could have chased a bigger headline by accepting lower grade and wider assumptions, but they chose a tighter resource and a higher grade orientation because that fits the business plan. And beyond the formal number, they speak comfortably about a much larger target over time, around 2 million ounces as a realistic goal, with upside depending on future results. Now, a target is not a promise, So I pushed into the next question. What are the goals from here? Because if you're serious, you don't just talk, you outline steps. The immediate focus is finishing the flow of results from the last drill season, then turning that data into higher confidence categories. In mining, confidence matters because it's what allows engineering decisions to stop being hypothetical. Inferred resources are, we think it's there. Indicated resources are, we're increasingly sure. Feasibility work demands more than vibes. It demands detail. And the timeline they're pushing toward is full production by 2028. Now, I want you to hear that correctly. They're not saying, we'll see. They're not saying, in the future. They're saying, a year, a target, a deadline. And that's where the market does something interesting. It stops valuing you like a lottery ticket and starts valuing you like a project, but only if you show proof. So what proof exists here? This is where the story becomes different from most conference chatter. They have a signed agreement to sell ore. Not maybe, not we're exploring options, a signed contract. And the destination is Taiwan. And let me be blunt. When I heard Taiwan, my ears perked up because that's not a marketing destination. That's not a country you throw into a pitch deck just to sound international. If material is moving there, it usually means someone on the industrial side has already done their homework, already ran the numbers, and already decided the feed has a purpose. Because buyers don't sign paperwork to be nice. They sign because they believe the rock solves a problem. And here's the first cliffhanger that most viewers miss. The problem being solved is not always, we need more gold. Sometimes the problem is, we need better inputs. That's why chemistry is such a big deal. In the real processing world, ore is not just ore. Ore is a recipe of elements, and certain elements behave like poison in the wrong concentrations. Too much of something and you trigger penalties. Too much of something and you slow down processing. Too much of something and suddenly a smelter is dealing with environmental, technical, or cost issues they do not want. So when someone tells you, our ore is clean, don't roll your eyes. Ask, clean compared to what? And clean enough to change the economics? Because clean ore can become leverage in a way retail investors don't understand. Let's make this simple. Imagine a buyer has a stream of shipments coming in. Some are high grade but dirty. Some are lower grade but stable. Some have high sulfur. Some have arsenic issues. Each shipment alone might carry penalties. But if the buyer can blend a clean ore into the mix, they can reduce the overall penalty profile, reduce headaches, and sometimes increase throughput. That means the buyer can make money not only on the gold, but on the optimization. And that's why a blending-focused trader can value clean feed disproportionately. Now there's another layer here, scale. A lot of retail investors hear direct shipping ore, and they assume the company is trying to stay small. That's not necessarily the case. Often, direct shipping is the first phase. It's the bridge that turns a resource into cash flow, and cash flow into confidence. Then, once the system is de-risked, the company can decide whether it wants to build more infrastructure, partner with a mill, or expand into a different processing strategy. In other words, direct shipping is sometimes the doorway, not the destination. And in this story, the doorway matters because it shortens the time between rock exists and money exists. Now, I want to address the question that always pops up at this point. If direct shipping is so great, why doesn't everyone do it? Because not everyone can. You need the right ore characteristics. You need the right logistics. You need a buyer willing to commit. You need a product that can be prepared without complex processing. And you need consistency, because a buyer doesn't want a one-time surprise. They want a repeatable feed they can plan around. That's why the bulk sample matters so much. A bulk sample is the moment a story meets friction. Real equipment, real handling, real variability, real recovery, real costs. And when bulk sample outcomes outperform expectations, it tends to do two things at once. It boosts confidence inside the company, and it boosts credibility outside the company. So when you hear, we did a bulk sample and it beat expectations, don't treat it like a random press line. Treat it like a stress test result. Now here's the second cliffhanger. Once a buyer trusts your feed, you can negotiate from a different posture. You're not begging the market for patience anymore. You're saying, we can move material, we can generate revenue, we can keep advancing. And that posture matters enormously when the market turns choppy, because choppy markets punish stories that rely on constant dilution. Now, the Taiwan angle also hints at something bigger. Asia is not just a consumer of finished goods. Asia is an engine of processing and industrial optimization. When you see demand behavior there, you're seeing the supply chain thinking ahead. And this is where a lot of Western retail investors are behind the curve. They only watch price charts. They don't watch procurement behavior. But procurement behavior is often the first whisper of the next wave. So the moment you see an industrial buyer making decisions that imply long-term planning, you pay attention, even if the headlines are still sleeping. And yes, before someone comments, But John, what if it's just a small shipment? Sure, it could start small. Most meaningful relationships start small. The point is not the first shipment. The point is the establishment of a repeatable lane. Now let's talk about the practical side of the lane, preparation. In this discussion, the concept wasn't about building a complex plan immediately. It was about making the product shippable through basic size reduction, creating a consistent physical product that can be handled, transported, and blended. That matters because complex plants introduce complex delays. Permitting, engineering, procurement, construction, commissioning, each stage adds time, cost, and risk. Basic preparation can reduce that complexity in the early phase. And again, I'm not saying plants are bad. I'm saying timing is everything. You don't want to build a cathedral before you've proven the congregation shows up. And in mining, the congregation is the buyer. Now, let me connect this to the conference vibe again, because you can actually see the psychology shift in real time. In bear markets, conference halls are half empty, and everyone whispers like they're embarrassed. In bull markets, conference halls are packed, and everyone talks like they always believed. What I saw this time was not just optimism, it was urgency. Urgency shows up when capital senses it might miss the next leg. And when urgency shows up, the market starts valuing timelines. That's why the 2028 production target matters even if it's years away. It creates a narrative clock. Investors can place milestones on a calendar and judge progress. Analysts can model. Funds can justify positions. The story becomes measurable. And measurable stories tend to travel farther than vague stories. Now, why does that matter? Because Taiwan is not the first country retail investors think about when they think of metals demand. When a demand signal comes from a place that isn't being spammed on social media, you should pay attention. Quiet demand is often smarter demand. The buyer here is a large metals trading group that specializes in blending ores. This is crucial, so don't skip it. Their competitive edge is not just taking one type of ore and processing it. Their edge is building a blended feed, bringing in ores from different sources, mixing them to hit desired chemistry, and then selling that optimized feed into downstream systems. And here's where the ore characteristics become a weapon. The ore in this story is described as clean, specifically low sulfur and low arsenic. That sounds like boring lab talk until you understand penalties. In the smelting and refining world, certain elements trigger penalty charges. Those penalties can reduce revenue, complicate processing, and create downstream headaches. So if you have ore that's naturally low in those penalty elements, your ore becomes valuable not just for its gold content, but for its chemistry. It becomes an ingredient. It becomes a balancing tool. It becomes the thing that makes other shipments more efficient. That's why the analogy came up that the ore can function like a helper ingredient in a recipe, improving the blend. And here's another key operational detail. The preparation requirements for shipping are relatively simple. The concept is to crush the material down to a manageable size, think gravel scale, so it can be shipped as direct ore feed. That can allow early movement without building a full-scale processing plant on day one. Now, if you're skeptical, that's healthy. So I look for one thing, real-world performance, and that's where the bulk sample comes in. A bulk sample is not a full mine, and it's not a guarantee, but it is reality. It's a test of how the material behaves when you actually move it, handle it, and evaluate outcomes outside of theoretical models. In this story, the bulk sample results were described as better than expected, with a net outcome discussed around $9.3 million, representing roughly 10 days of work. Again, I'm not telling you that guarantees a future. I'm telling you that it supports the concept, and it's a form of validation many stories simply don't have. Now, let's talk about the district itself, because the Golden Triangle isn't just geology, it's a chessboard. There are major assets in the region. There's activity around existing mills. There are groups trying to revive projects. There's infrastructure that can change what's possible. And for this company, proximity matters. A mill that's roughly 20 kilometers away is not the same as somewhere in the province. Distance is cost. Distance is time. Distance is leverage. Does that mean a partnership is guaranteed? No, but it creates optionality. And in mining, optionality is the thing you want before the market starts paying for it. Now let me zoom out, because if you only focus on the project, you miss the bigger reason these stories are getting attention. We're in a world where the financial system keeps leaning on the same lever. Create more currency units to stabilize whatever is wobbling. You can call it support, stimulus, liquidity, policy response, whatever. The label doesn't matter. The effect does. More units. Same real stuff. And that's why hard assets keep pulling attention. You can print digits. You cannot print ounces. You can adjust policy. You cannot negotiate with geology. You can promise stability. You cannot promise purchasing power. So when you see gold and silver moving, don't treat it like a random chart. Treat it like a message about confidence. Now, some people say, but is retail even here yet? I'll give you my honest read. Not fully. Not in the manic way. Not in the everyone on your street is talking about it way. Retail tends to arrive after confirmation, when the move feels safe. Institutions often position earlier. Central banks position for different reasons entirely. So, if central banks and institutions continue leaning toward hard assets, the floor under the sector can stay firmer than retail expects. And that's where mining stories become explosive. Because miners are leveraged to metal prices. If metal prices rise, revenue rises. Costs don't rise at the same rate in the short term. Margins can expand. And when margins expand, valuations can expand fast, especially for projects that look like they can actually move toward production. But here's the trap. In a hot cycle, investors chase anything that moves. They confuse a loud booth with a good project. They confuse a viral tweet with due diligence. And then they blame the market when the hype fades. So here's the filter I want you using. Does the company have a plan that makes sense? Does the timeline force discipline? Is there validation beyond "we think"? Is there a credible pathway to revenue? Is the story improving through measurable milestones? If those boxes are being checked, you're not just buying excitement, you're tracking execution. Now, I want to add something that helps you as a viewer, because I know some of you want daily updates and you don't want to wait for a full YouTube upload. I created a WhatsApp channel for exactly that. The link is in the description. I post daily notes, quick updates, and personal analysis there. I also share instant voice notes and fast alerts that I don't always put on YouTube. If you want to be early instead of late, join that WhatsApp channel. And while we're here, as you're watching this, a members-only video is already published on the channel. It's a single video that compiles the key updates so you can catch up quickly. Premium members also get deeper analysis from me, and honestly, it also shows me who is really following closely. If you want that in-depth layer, join the membership and watch the members-only video that's already live. All right, back to the core narrative. What impressed me in this discussion wasn't just the gold price environment talk. It was the way the story is structured around steps. Step 1, define a resource that matches an executable strategy. Step 2, validate ore behavior with a bulk sample. Step 3, secure a buyer relationship and a contract. Step 4, upgrade confidence levels and push toward feasibility. Step 5, build toward a production timeline. Each step de-risks the story, and each step is a potential catalyst the market can price. Now, I want you to imagine two parallel futures. Future 1, the company executes, resource confidence improves, logistics are refined, and the market starts paying for the pathway. In that future, the story can re-rate and optionality increases. Future 2, delays hit, costs inflate, timelines slip, and the market loses patience. In that future, you get dilution and disappointment. That's mining. And that's why you don't marry a stock. You track a story. You watch whether management turns plans into progress. Now, a personal question came up in the conversation that actually revealed something deeper. What do your kids think about this industry? Because to outsiders, mining looks old. It looks like an odd career. But the people inside the cycle understand something. Commodities are the foundation of modern life. You can't build the future on wishful thinking. You need real materials, real supply chains, real inputs. And when families internalize that, they start treating hard assets and commodities as a literacy skill. Not a hobby, a skill. Now here's the next cliffhanger, and I want you to really hear it. If the buyer side of the world, traders, smelters, processors, starts competing for clean, blend-friendly ore, then ore chemistry becomes more valuable than retail investors currently understand. If penalties become a bigger deal, clean material becomes premium. If blending becomes a bigger bottleneck, consistent clean feed becomes premium. And if more buyers start building capacity around certain feed types, the producers of those feed types gain leverage. So when you see Taiwan demand, don't just think destination. Think signal. Think industrial appetite. Think strategic procurement. Because demand shifts always show up quietly first. Now I want to involve you because engagement is how we make this channel stronger. Question 1. Do you think the next big upside in this cycle comes more from gold or more from silver? Question 2. If you were an investor, would you rather own a near-term developer with a real pathway or a pure explorer with bigger upside but no timeline? Answer both in the comments. And remember, if you want to support the campaign against recycled, copycat content in this space, subscribe and comment Our John AG. It's a simple action, but it's a strong signal. Also, if you're successful, any success, share it in the comments. Tell us what worked for you. It motivates others, and it builds a smarter community. Even if it's a small win, share it. People learn faster from real stories than from theories. Now, quick creative line in the middle, because I promised I'd do this in a way that's actually useful, not awkward. If you're someone who loves silver and you want to hear silver-related success stories specifically, there's a link in the description to another channel. Check it out and subscribe there too. You'll see how people approach silver moves and how they think about timing. All right, let's tighten the focus again. The reason I'm covering this story is not because it's the only story. It's because it's a clean example of a theme. The theme is this: projects that can move rock and sell it, even on a smaller scale first, start to separate from projects that only exist as potential. And in a strong metals environment, the market tends to reward separation, but it rewards it in bursts. One resource upgrade can change sentiment. One feasibility update can change valuation. One financing done from strength can change everything. One strategic buyer relationship can flip the narrative. And that's why this sector is brutal. If you're late, you're buying after the burst. So here's what I want you watching next in stories like this. Watch for resource upgrades and category improvements. Watch for consistency. Does the story keep getting tighter or does it get more vague? Watch for logistics decisions that reduce risk. Watch for financing structure. Does it protect shareholders or punish them? Watch for execution pace. Do they keep moving or do they stall? Now, let's talk about something that sounds small but changes everything in a bull cycle. Narratives. Every cycle has the same playbook. At the beginning, nobody believes. In the middle, people argue. Near the top, everyone pretends they knew. And right now, we're in that dangerous middle phase where the media can't decide whether to hype metals or dismiss them. So you see a weird mix. One day it's gold is unstoppable. The next day it's this is the top, sell everything. If you've been around long enough, you know why that happens. Big moves attract attention. Attention attracts fear. Fear creates volatility. Volatility shakes out weak hands. And then the move continues without them. So if you want to survive this, you need a process that's stronger than your emotions. Here's a simple one I use. I watch for 3 categories of signals. First, the price signal. Is price moving with momentum, and is it holding gains rather than instantly collapsing? Second, the participation signal. Are new people entering, or is it still the same small group talking to itself? Third, the supply chain signal. Are buyers behaving like they expect tighter conditions ahead? The third one is the most ignored, and it's why stories like Taiwan matter. Procurement behavior often speaks before social media does. Now, on the participation side, the signs of real retail arrival are obvious when they happen. You see it when mainstream influencers who never cared about metals suddenly start making videos about gold. You see it when friends who mocked the sector ask, "Is it too late?" You see it when coin dealers, online retailers, and physical supply channels start talking about delays and premiums again. And you see it when the comment sections fill with brand new questions instead of the same 10 usernames. We're not fully there yet, but when it arrives, it will arrive fast. And that's why I keep hammering the idea of milestones and execution. Because when the crowd arrives, they don't buy potential. They buy what looks safe. And safe in mining usually means a visible path to revenue. Now, let's talk risk for 1 minute, because virality without honesty is useless. Mining is not a straight line. A good project can still get hit by inflation. A good plan can still get delayed by weather. A good story can still raise capital at a bad time. So if you're positioning in this space, do it like an adult. Size your bets. Don't mortgage your peace of mind. And track catalysts like a scoreboard, not like a prayer. If the story is executing, you can stay patient. If the story is stalling, you can step back. That's how you avoid becoming exit liquidity. Now, one more retention point before we wrap. The difference between resource and reserve. A resource is a geological statement. A reserve is an economic and engineering statement. The market pays up as you move along that spectrum because each step reduces uncertainty. So when you hear talk about pushing toward feasibility and production targets, that's the deeper meaning. They're trying to move along the spectrum from interesting to bankable. And that is exactly where re-ratings are born. Now, final stretch. I want to close with a promise and a warning. The promise. I'm going to keep bringing you stories with real details, real catalysts, and real lessons, not recycled content. That's the whole point of this channel. The warning. The next phase of this hard asset cycle will not be polite. It will be fast, emotional, and crowded. It will reward preparation and punish chasing. So if you've gotten value from this breakdown, do 3 things. First, subscribe and comment Our John AG. Second, join the WhatsApp channel in the description if you want daily posts, fast updates, and my instant analysis and voice notes. Third, if you want the 1 video catch-up with premium depth, join the membership and watch the members-only video that's already published. Also, if you're the kind of viewer who watches quietly, here's a challenge. Write one sentence in the comments explaining what you're watching for next: resource upgrade, financing, offtake details, or timeline progress. That one sentence trains your brain to think like an investor, not a gambler. And when you see someone else's comment that's smart, reply to it. Build the community. It compounds. If you want, include your biggest mistake too, so others avoid repeating it. And now, your move. Are you watching this cycle like a spectator, or are you positioning like it matters? Drop your answers below. Share a success story if you have one, and I'll see you in the next video.